Hello, this is Joe Pryor, the virtual real estate team in Oklahoma City, and this is a new series of 5 videos on what is a 1031 tax-deferred exchange. Now, if you're an owner-occupant, this is not for you. This is for investors. The 1031 is right up there with compound interest for me as one of the greatest things that exist in real estate. And let me tell you why. Years ago, there was a family, Starker family, because it used to be called a Starker exchange, that successfully sued the IRS and won. It was David beating Goliath, essentially, based on the fact that they were selling a property, buying other properties, and they felt like that the taxes should not be paid, essentially, on that new property, and they won. And so the 1031 refers to, now a part of the tax code, about how you handle selling a property, buying more property, and not having to pay any kind of taxes on that property. Now, the good news about a 1031 exchange is you can do as many of these as you want. It's not limited to one time. In fact, the beauty of a 1031, if you, in a way, I guess, is you can do it all the way and defer your taxes till literally the day you die, which is the ultimate tax break, because guess what happens? Your heirs take over the property, but no taxes whatsoever are due on that property. Because here's the deal. If you do sell a property and then you're buying, if you buy a property, what the IRS is going to do for you, if it's an investment, is give you a depreciation schedule. That is on residential, 27.5 years. It's like 39 years on commercial. Well, let's stick with residential. And essentially it means that we take out the land because land is not depreciable, and just the improvements. So let's say there's $150,000 left after you take the land off. Well, then you divide that by 12. And if you want to buy another, by 27.5 years, then by 12. So we can see what our monthly write-off is going to be. So if you have a $350 a month positive cash flow after expenses, your depreciation is like $431. And so to the IRS, you're actually losing money, which is really cool because it's money you're not going to be paying taxes on. You're actually carrying forward a loss. But if you do sell the property outright, what the IRS says, well, if you've taken $10,000 in depreciation, you've got to pay us 25% of that back. And so that's very simply $2,500. But then there's another tax that comes in, which is called capital gains. So you have what's called a basis, which we'll deal with later. It's reduced off by that $2,500. Then what is left is what is capital gains for you. Now, one thing that we know going forward in 2021 and beyond, it's a pretty good chance capital gains is going to go up. There's a lot of money that's been floated post-COVID or during COVID, trillions of dollars, basically in stimulus money. And so that's going to have to be paid back. And they always look at capital gains to do that. But let's say it's 20% or 30%. Then you've got to pay that tax. But with a 1031 tax deferred exchange, none of that has to be paid. There are no taxes. It's like the IRS saying, here, take this money and reinvest it into something else and keep your investment going and making even more money with it, and also buying multiple properties, which we're going to deal with in the next video. We're going to talk about some of the basic rules of 1031s so you understand what the IRS wants you to do and what you can do.